So the art of selling a stock at the right time is a game changer. It can mean the difference between a very successful investor or a chance taker. But how do you know when to pull the trigger? Well, in this video, I'm actually going to share with you expert strategies from the likes of Warren Buffett and more, and also insider tips for timing your sale perfectly. So from navigating market peaks to navigating emotional decisions, in this video, we will go through all the tips to give you confidence and clarity to make the smartest move. So if you're actually ready to turn your investments into success stories, then go ahead and like this video and subscribe to the channel. So guys, before we start with the video, please note that I'm not a financial advisor and none of my videos constitute as financial advice. If you're seeking for any financial advice or financial advisor, please be sure to look for someone who is certified and also who is registered with the FSCA. So there are tons of reasons why you should sell your stocks, but are you actually selling your stocks for good reasons or just bad reasons? So I'm actually going to help you identify your reasons by actually giving you both good and bad reasons as to why you should sell your stocks. So guys, I'm actually going to start with the good reasons. So the first good reason why you should actually start selling your stock is number one, overvaluation. So if the stock has significantly surpassed its fair value, or if the market conditions have changed so that the stock is now overpriced, it might be a good time to start selling. So selling when a stock is overvalued can actually help lock in profits and prevent losses when the market inevitably corrects itself. Reason number two, poor company performance. So if the company's fundamentals deteriorate, such as declining revenues, shrinking margins, or management issues, it might indicate that the stock is no longer a good investment. So selling in such cases can actually help prevent further losses. So an example of a poor company performance was back in 2017 when Stanoff International Holdings, a South African multinational retail company, was actually embroiled in an accounting scandal that revealed irregularities in its financial statements. So the revelation led to a significant drop in Stanoff's stock price as investors lost confidence in the company's management and also financial integrity. So investors who sold their shares upon learning about the scandal actually mitigated a lot of their losses. Number three, rebalancing your portfolio. So selling a stock might be necessary to rebalance your investment portfolio. So if one stock has grown significantly and now represents an oversized portion of your portfolio, selling some of it can actually help maintain a diversified and balanced portfolio. So for example, suppose a South African investor initially allocated a significant portion of their portfolio to Naspers Limited, and over time Naspers stock appreciated substantially over time, leading to an overweight position in the investor's portfolio. So to rebalance and reduce exposure to Naspers, the investor decides to sell some shares and diversify their portfolio into other South African companies or international assets. Number four, changing investment goals. So if your investment goal or risk tolerance change, it might necessitate selling certain stocks. So for example, if you need to fund a short-term financial goal, or if you become more risk averse due to changing life circumstances. So selling some stocks to reallocate your investment can actually be very prudent. So for example, a South African investor who originally focused on high growth stocks may actually decide to transition to a more conservative investment strategy as they approach retirement. So as part of this transition, the investor may sell shares of high risk, high volatility companies like technology startups or small cap firms, and also reallocate their investments to more stable blue chip companies listed on the Johannesburg Stock Exchange known as the JSE, such as Standard Bank Group or Sasol shares. So reason number five, external factors. So external factors such as changes in economic conditions, regulatory environment, or industry trends might make holding onto a particular stock less attractive. So keeping an eye on these factors, selling if they negatively impact the stock's future prospects, can actually help preserve capital and also potentially generate better returns elsewhere. So for example, back in 2020, the COVID-19 pandemic caused disruptions to global supply chains and also reduced customer spending worldwide. So South African retail companies including Woolworth Holdings Limited actually faced challenges such as store closure, supply chain disruptions, and decreased foot traffic. So investors actually recognized the adverse impact of the pandemic on the retail sector and sold their shares in companies like Woolworth, actually minimized their losses and redirected their investments to more other investment sectors that actually were less affected by the crisis, such as healthcare or technology sectors. So that was it, guys, on good reasons why you should actually start selling your stocks. Now let's go and talk about the bad reasons why you shouldn't actually sell your stocks. Oh, and if you are currently liking this video, guys, please be sure to like and subscribe to the channel. So bad reason number one, emotional attachment. So emotional attachment to a stock can cloud judgment and lead to irrational investment decisions. So holding on to a stock simply because you have a sentimental attachment to it can actually prevent you from selling, even when it's financially prudent to actually do so. So a very big prime example of this is imagine an investor who has held shares in a South African company like MTN Group for many years and also feels a very strong emotional connection to the stock because it was their first investment. But despite deteriorating fundamentals or better investment opportunities elsewhere, the investor actually refuses to sell MTN Group shares due to emotional attachment. So bad reason number two, fear of missing out, which is FOMO. So fear of missing out actually occurs when investors are actually afraid to sell a stock because they worry about missing out on potential future gains. So this fear can lead to investors to hold on to stocks longer than they should, even when the fundamentals deteriorate or investment thesis no longer holds true. So for example, suppose a South African investor holds shares in a tech startup that actually had a very successful initial public offering, which is the IPO, and experienced rapid price appreciation. But despite concerns about the company's long-term viability and also increasing competition in the industry, the investor hesitates to sell due to a fear of missing out on further gains. So bad reason number three, anchoring bias. So anchoring bias occurs when an investor fixates on a specific price they paid for a stock and refuses to sell unless the stock reaches that price again, regardless of the current market conditions or the stock's intrinsic value. So for example, consider an investor who purchased shares in a South African pharmaceutical company at a high price during a market rally. But subsequently, the stock price declines due to regulatory challenges or disappointing earnings. But despite the negative developments, the investor holds onto the stock, hoping it will actually eventually return to the initial purchasing price. So bad reason number four, herd mentality. So herd mentality refers to the tendency of investors to follow the actions of the crowd without critically evaluating the underlying fundamentals of an investment. So selling stocks solely because others are selling or holding onto a stock because others are also holding onto them can lead to suboptimal investment decisions. So for example, during a market downturn, many investors actually panic and sell off their holdings in South African financial institutions like Standard Bank Group or equities due to fear of economic instability. But however, selling shares based solely on the actions of others without actually considering the long-term prospects of the company can actually result in selling at a loss or missing out on potential recovery. So bad reason number five, lack of understanding. So holding on to stocks because of a lack of understanding of how the stock market works or the fundamentals of which the company you've invested in can actually be a detrimental reason to avoid selling. So ignorance of market dynamics or company fundamentals can actually lead to missed opportunities or increased risk exposure. So for example, suppose an inexperienced investor buys shares in a South African energy company without actually conducting thorough research or understanding the complexities of the energy sector. So as the stock price actually fluctuates and the investor holds onto the shares without actually realizing the impact of regulatory changes or the shift in global energy demand on the company's performance. So now guys, that you've actually peeled back all the layers of the good and bad reasons behind selling stocks, it's actually now time to actually ask the pivotal question, which is, Shava, which stocks should I actually sell first in my investment portfolio? So the stocks or shares that you should actually sell first in a portfolio are stocks with the highest gains. So selling shares that actually have seen significant appreciation can actually help lock in profits. But however, keep in mind that this may trigger capital gains tax. And in South Africa, if you've actually held shares for more than 3 years, you may be eligible for a partial exemption on capital gains tax. And secondly, you should sell underperforming shares. So guys, actually consider parting ways with shares that have consistently underperformed and also show little signs of recovery. By actually selling underperforming shares, you not only free up capital, but can also utilize capital losses to offset gains for tax purposes. And number three, shares outside your risk tolerance. So if you find yourself holding on to shares that are actually too volatile for your comfort level, actually consider selling them. Aligning your portfolio with your risk tolerance is actually a very crucial thing, especially during periods of market volatility that may actually induce a lot of stress. You'd actually also consider selling shares with changing fundamentals. So evaluate whether the reason you initially invested in a particular share actually still holds true. So changes in company leadership, market dynamics, or regulatory shifts may actually warrant selling those shares to realign your portfolio with evolving realities. So all in all, when deciding which shares to sell, it's very essential to consider your overall portfolio strategy, your diversification goals, and also the tax implications specific to South Africa or whichever country you live in. And also guys, additionally, reviewing individual share performance in the context of a broader market and also industry trends can actually provide very valuable insights. Alright guys, brace yourselves because we are now diving into the holy grail of investment wisdom. So guys, what I'm about to reveal is the pinnacle of exclusivity, which is the 8 best kept secrets of selling stocks. So if you stuck around until now, consider yourself part of an elite group eager to actually gain insider knowledge. But before we unravel these secrets, do yourself a favor and hit the subscribe button and show some love with a thumbs up. So now guys, let's peel back the curtain and uncover the secret strategies only known to the best investors. So secret number one, everyone makes mistakes. Just be sure to cut all losses short. So even the best investors get hit with a loss from time to time, but they don't indulge in worry as the stock drops even further. So they cut their losses quickly and move on. So leave your ego and pride at the door and don't let a loss get into you either mentally or financially. Secret number two, if you don't sell too early, you'll sell too late. So to lock in solid gains, you sell while your stock is still going up. Because remember, your objective is to make and take significant gains and also not get excited, optimistic, greedy, or emotionally carried away as your stock advantage gets stronger. So following the 20 to 25% sell rule will actually help you do that. So guys, if you actually want to know about the 20 to 25% sell rule, if you want me to make a video about it, then comment and tell me in the comment section below. So secret number three, having a selling plan in place before you buy. So the real drama kicks in when it comes time to sell. So if you don't have sell rules and an exit plan to guide you, it's easy for you to freeze and not take action when you actually need to do so. So if your stock is soaring, you might get greedy and ignore all sell signals and warning signs. So if you are sitting on a loss, you may do the hold and hope routine, praying that it bounces back while it continues to drop. So stay grounded and guys, and remember to keep your emotions at bay by having a selling plan in place and ahead of time. So write down your target sale price for both taking profits and also cutting losses. Secret number four, don't let a decent gain turn into a loss. So if you have a nice gain of let's say 10 to 15% or more and the stock begins to decline, don't let that profit disappear completely. It's much less frustrating to see a 15 to 20% gain turn into a 5 to 10% profit than to see it turn into a 10% loss. So you can always buy the stock back if it shows renewed strength and actually forms a proper buy point. So secret number five guys is very important, so listen up. Don't marry your stocks, just date them. So for better or for worse, for richer or for poorer is a great and time-honored approach when it comes to your spouses and when you're actually marrying them. But it's a very bad idea when it comes to investing in stocks because in most cases, it's better to take a good gain while you still have it and never hesitate to separate yourself and protect yourself from a bad relationship if there are clear signs of trouble. So secret number six, sell your losing stocks first. So guys, when you are building a winning soccer team, you wouldn't actually trade away all your top players for a bunch of bench warmers. Yet many investors do just that. What they do is that they sell stocks in which they actually have a good gain and hold on to those showing a loss, thinking that a big gain is just around the corner, and that's just usually wishful thinking. So do the opposite. Sell your losers and also use that money if the market trend is favorable to add winners to your roster or invest more money in the top performers that you already own. So secret number seven, when buying a stock, focus on both fundamentals and the stock charts, and when you're selling, focus mainly on the charts. So the warning signs typically show up in the stock chart mainly on the technical analysis before they actually appear in the company's fundamentals. So guys, while it's actually very crucial to use both technical and fundamental analysis when you are buying stocks, when you're actually deciding to sell or when you want to sell stocks, focus on the charts and technical analysis like the price and volume action and behavior around key moving averages. So secret number 8, the most important sell rule is to buy at the right time. So a very common mistake, particularly for beginning investors, is buying at the wrong time. So some will actually not pay attention to market timing and buy during a market correction when most of the stocks are actually going down. Or what they'll do is that they'll all ignore the technical action in the stock chart and either go buy too soon or sell too late. So before buying a stock, make sure that these three key factors are in place, which is market trend, big earnings driven by something new, and institutional support. By doing that will actually help you make sure that you get in at the right time with the odds of success squarely in your favor. So the bottom line is, selling a stock should not only be an impulsive decision based on emotions or herd mentality. It should actually be based on a strategic move based on thorough understanding of the stock valuation, the company's performance, and also your portfolio balance and investment goals, and also external market factors. So it's also vital to actually have a selling plan in place and to understand when and why to sell a stock. So guys, we've actually came to the end of the video. If you actually want to know how to research a stock before you buy it, then I highly suggest you to watch this video right here, and I'll see you on this video.